Hi everyone, it's Paul Tilley and welcome back to TM1040, which is Financial Management module for our Skills Trades in Business program. Today I wanted to talk about this last topic, and that being cash flow. Now, cash flow is a bit of a challenging subject if you're not familiar with accounting. So what I want to do, and the purpose of this particular section, is to introduce you to the concept of cash flow more than anything else. It's not, again, to make you an accountant. It's to give you an appreciation for why accountants use this tool. Okay? So first and foremost, what I want you to do is to have an appreciation of what we're going to do here. So first and foremost, we're going to look at exactly what a cash flow analysis is, and we're going to effectively be able to interpret what those things are saying to us and how can we use it to help better manage our business. That's our primary goals. Okay, first I want to talk about cash, and really cash is king in a business. If your business can't generate enough cash to pay its bills, then your business will fail. Okay, so when it all comes down to, no matter what the business is, whether you're Walmart or a little firm producing cupboards, the fact is that you have to generate income in the form of cash. I want to differentiate between income and cash here, because from a cash analysis, what we're looking at is how much cash do you have in the bank, the real dollars and cents. This is differentiated from earning. For example, I could earn $30,000, but if I don't physically have the $30,000, I earned it, yes, but I haven't received it yet. So what we're looking at is hard, cold, hard cash in the bank available to you to work. And that's really what the primary goal of this unit is looking at this cash analysis. I have an example here of a very simple balance sheet. Now, keep in mind, the balance sheet consists of three parts: assets, the liabilities, and the owner's equity. And assets match the liabilities and owner's equity, own versus owe. Okay? I've only shown you in this particular graphic one aspect of the asset, and that is cash. Okay? We're only interested in the asset cash for our purposes of demonstrating this. So I have shown here a balance sheet for December 31st, 2019 and December 31st, 2020. So we got a beginning date, December 31st, 2019 is the same as January 1st, 2020. Okay, so this is the start of the year. And at the start of the year, there was $84,000 in the bank account of this business, ABC Excavating. The business operated all year, right through the year. And at the end of the year, as I was saying, we do another financial analysis to find out how much money is in the bank. That creates a balance sheet for us. And if we look at the balance sheet for cash, in this particular one at December 31st, 2020, you will see that there's $44,000 in the bank. So it went from $84,000 at the beginning of the year down to $44,000 at the end of the year. And we ask ourselves, why? Why is that money going down? And really, the purpose between our assessment of cash and using cash in order to analyze where this is going, why, is to answer that basic question. Why did the account go down, or why did the account go up? What did we do in the course of the year to cause our cash to change? Okay? So fundamentally, that's what we're doing with our cash analysis here. So let's look at some of the tools we use in order to answer why. The tool we use is something called the cash flow statement. We've already introduced the concept of the financial statements involving the balance sheet, which is a measure of assets, liabilities, and owner's equity, a snapshot of what the company owns at any point in time and owes at any point in time. And we've also introduced the concept of an income statement, which measures the income that flows into a business from the beginning of the period to the end of the period. It is a time measure. The income statement will tell us things like how much business the business generated, how much income did it make. But by now you should realize that just because we've earned it doesn't mean we've actually received it. If you go to work for me and you work for a week and I don't pay you until the second week, you have earned a week's worth of income, but you haven't physically received any cash. So the difference between the income statement and what we're looking here with the cash flow statement is to ask ourselves, how much money do we really have? How many dollars do we have in our bank as opposed to how much we're owed or how much we owe? Okay? So our cash flow statement is critical because it tells us, do we have enough money to pay our bills? Do we have enough money in the bank to pay the bills? Okay? So that's really what this is at. The cash flow statement is very similar to the income statement in that it measures a point in time from the start to the finish, and it measures this adjustment in our cash over that period of time. Now, so how do we get there? How do we convert our income statement into a cash flow statement? Well, that is the real challenge here. And even though we're not going to actually be doing it, what I want to show you is how accountants do it. Okay? So, as I say, the cash flow statement is intended to show us how the cash goes up and down. Now, in terms of up and down, an up, when cash comes into our business, when physical cash comes into our business, that's called a positive cash flow. In other words, the money is flowing in and filling up our business's bank account. You think of it like a bathtub, okay? The water is going into the bathtub and is draining out of the bathtub. We ask ourselves, is the water going in faster than it's going out? Because if you think about a bathtub, if the water goes in faster than it goes out, the water in the tub will rise. Alternatively, if the water goes out faster than it goes in, the water in the tub will drop. Well, what we're trying to do here is ask ourselves, is the water going up or down in the tub? Okay? So that's what we're looking at for this cash flow. Now, why is it? Should we bother with this? What's the big deal? Well, the thing we need to be able to ask ourselves is, what do we want to get out of this? Okay, so as the owner, we want to know, do we have enough cash to operate? Do we have cash coming into our business? Are our bills being paid? Do people pay us? Are we being able to pay our bills? What are we spending our money on? These are all things that really the cash flow is going to help tell us. From an outsider's point of view, banks are going to look at it and say, can they pull the cash into their business? Are they generating a good flow of money into the business? Because if they're generating a good flow, we can loan them more money because more likely they're able to generate the dollars in order to pay the bills. Accountants want to know this information because, again, they're going to be interested in how much business your business is doing in terms of sales. Lenders, as I say, investors are going to be interested in this. Should I invest in your business? Does your business make money? Is it really being able to generate money? Potential employees are going to look at it. They're going to say, is this business of yours worth coming on board with? Am I going to be able to get paid? Do the business have enough money to pay me? Will I get paid on time? These sorts of issues. And obviously, you're going to be answering all of those people whenever you look at cash flow, including yourself. So those are some key things that you need to look at with regards to why you should have a clue of how these cash flows work. Okay, so we know by now you should realize that cash flow is an ability to think how much money is flowing into the business, how much money is flowing out of the business. In order to get the most possible information out of this flow, so instead of just saying is water going in, water going out, you have to say what kind of water is going in. What is it that we're getting the money from or spending our money on? So the cash flow statement, in order to be able to tell us those things, splits money flowing through a business into one of three categories. Okay, the first category is something called operations. Operations is the normal flow of funds in the business from its basic operation, its reason to exist. Why does this exist? If the money is coming because it exists for some reason, so if you own a carpentry firm, operations could be money that you make building houses or money that you have filling contracts. These are the types of business. If it's an excavating business, as I'm talking about in the example here, digging holes, using your equipment to make money, to do projects, that's operations. Operations relates to revenue, income into the business, expenses from the business, and it all relates to the short term. So as your business is moving along through the year, so this is all very short-term money. So what you need to think about when you're looking at operating activities is asking yourself, what is the cash flow that's created by the day-to-day operations of this business? And what you can do is identify all of the revenues and expenses that you occurred during the period that you're reviewing to say, is this operational? Is this money being spent in order to sustain the business, or is it money that's coming into the business from its normal operations? That's the first thing. The second type of money that you're going to be looking at, or the second type, deals with investing activities. This is money that you put into the long-term sustainability of the firm. So you're buying stuff. So you're buying equipment. You're buying buildings. You're buying assets that allow you to generate money into the future. So cash flow resulting from investing activities, such as the purchase and sale of assets, such as land, building, equipment, etc., or they could be loans made to suppliers or receivers of customers, payments related to mergers and acquisitions. Investing activities draw from changes in non-current assets and non-current liabilities. So it's a longer term. So any funds that are received or spent to invest in the business, meaning a long-term purchase or a long-term operation, that's what would be classified as investing activities. Finally, we're looking at financing activities. Now, financing activities looks at the right-hand side of the balance sheet. So it says, is this something that changed our shareholders' equity? Did it go up or down because of that? Did it increase our loans or decrease our loans? Those types of flows of money are related to as financing activities. So debt and equity dominate the cash flow for financing activities. Financing activities are the cash flows that result from funds invested by the business owners, or loans or equity investments from outsiders. Financing activities are key indicators to investors of how much money is going into the business in order to sustain it. So financing activities draw on changes to long-term liabilities and changes to the firm's owner's equity. So what we need to be able to do is classify all the flow of funds into one of those three categories. Now, you will see in this particular graphic here, the components of cash flow statements, that in the center one, the business activity, I have indicated one of the three categories: operating activities, investing activities, and financing activities. To the left and the right, you can see cash receipts or cash payments. Notice that cash has to be involved. Okay? So in terms of operating activities, collections from customers, receipts of interest or dividends from investments, or other operating receipts are all considered as operating activities, cash receipts in. In terms of cash payments and operating, payments to suppliers, to employees, to interest, to income tax, to operating payments, these are all ways that money gets spent or expended out of the business related to operations. Next, I look at investing activities. Well, we think about cash receipts coming into the business from investing activities. Well, sale of capital assets. So you sell a tractor, you sell a building, or something that you had in your inventory of assets, you sold it off, so you no longer have that. Sale of investments, stuff that you've invested in, other firms, other entities, these sorts of things, you sell them off. That generates cash into your business. As you sell it, you get money for it. Receipts on loan receivables. You go to the bank, get a loan. That money comes into your business. $1 million loan, for example, comes into your business. That's an inflow of dollars. In terms of cash payments for investment activities, acquisition of capital assets. You go buy a new tractor, for example. If you're a construction firm, that's an example of acquisition of capital assets, and you pay money out for that. Purchase of investments. So you go buy interest in another firm, or loans made to others. This is money going out. Again, tends to be longer term. Finally, we look at financing activities. And when we think about financing activities, it relates to the owners, or it relates to loans that the owners draw down. So, for example, cash receipts come from selling ownership shares in the business. So if you sell a share of the business to someone else, that money comes in from them. They own part of the business, and in return they pay you money. borrowing money. So for long-term debt, we go and get a mortgage on a building. The mortgage comes in to pay the cost of the building. We use it to pay for the building. We're going to pay that back over time. But we get the money up front. In terms of cash payments, too, from finance activities, we think about money taken out of the business by the owners. Okay, the owners say, okay, I'm going to draw away some of my ownership in this business. I'm going to take money out of the business. I put $1 million into it. Now I'm taking $500 out. So that money is being drawn out of the business. That's a form of financing activity. Buyback of ownership shares. Some companies buy out its owners or buy other owners out or buy back shares. Or repayment of company debt. The company, as it pays money out to someone like a bank that they loan money to loan money to the business, you pay them off. That's an example of it being paid back and cash flowing out of the business. So those are the various components. Now, from an accounting point of view, what accountants need to do is to prepare these statements by, first of all, looking at your balance sheet at the beginning of the period. And that way they can determine how much money was in the bank. Okay? Then they're going to look at the balance sheet at the end of the period, and they're going to know how much money was in the bank. They're going to look at the income statement to look at the flow of revenues and expenses through. They're also going to look at your accounting or record-keeping information as we call them journal entries. So these are, as the business moves along, it does certain things. It buys stuff, sells stuff, has customers come into the store, bringing in receipts. All of these things bring money in or expel money from the business. So what it does is it keeps a record. It has to find out all these cash transactions or near cash transactions. And it then takes that cash that was figured out in here and puts it into one of the three categories I just described. Is it an operating, is it financing, or is it investing? So what we're doing then is we're saying to ourselves, all of these flows of cash, we're going to measure them and we're going to net them out. Okay? Now, once we've done that, we build what's called a cash flow statement. Now, I will show you an example of a cash flow statement here. Here's a very simple one for ABC Excavating. Okay, now if you remember, you go back and you say, okay, well, ABC Excavating in 2019, they had $84,000 in the bank. In 2020, it was down to $44,000. What happened? What happened? So what we're trying to do is ask, why did it change? Okay, when we compile all the figures, you will get a statement like this, and it will tell you and break it down by the 3 areas. Cash flow for operating activities. Okay, first of all, we're going to see that it collected $542,000 from customers, and it received $38,000 worth of interest for total cash receipts of $580,000. So that money came into the business. It made payments. It paid suppliers, employees, interest, and taxes, and a total payments of $444. Now you notice I have that in brackets. The reason is that's brackets just mean a subtraction or a negative. So 580 came in, 444 went out for a net of 136 in. So it was to the good, $136,000. So from operations, we just look at the operations of the business. The business is $136,000 better off at the end of the year than it was at the beginning of the year. Okay? Then we look at cash flow from investing. We see what did the business do that had to do with investments, and how did that affect the cash? Well, the cash purchase of a new tractor. Someone went and bought a tractor for $634,000. They sold their old tractor for $124,000. So the net investment was $510,000. So $510,000 went out of the business in order to get that tractor. So you got a tractor, but you gave up $510,000. So we see that that's $510,000 to the not good. It's gone out of the business. Then we look at cash flow from financing activities. Well, how do we finance it? Well, we sold some shares in the business, and we pulled in $202,000 there. We got a loan from the bank that pulled in another $188,000 into the business. We paid off a long-term loan. $22,000 went out of the business, and we paid dividends to the owners for $34,000. That nets out to $334,000 came into the business from financing activities. Now, if we add up all in, so we had 136 net from operating, 510 negative from investing, and 334 net positive coming in from financing activities. That gives us a net decrease in $40,000. We add those numbers together, that would come out to negative $40,000. And we ask ourselves, well, we started off with $84,000 in the bank. It went down to $44,000 in the bank, a difference of $40,000. This calculation here in the cash flow statement explains why the cash went down, okay? So we see that our operations were very good. We made a lot of money in operations. In fact, we made $136,000 net operating our business. We did buy that tractor, though. That took $510,000 net. That took $510,000 out of the business. And we did have some financing. The financing brought $334,000 into the business. So we've taken on more debt, but we've also bought a piece of asset that was $510,000 that took out of the business. So we ask ourselves, is the business better off? Well, in the long term, yeah, we bought a new piece of equipment to do the job we do. We're an excavating company. We do that. We need a tractor to make money. So it kind of eases our mind to say, yeah, well, we've used that money to buy something of use that will generate profit or generate revenue for us into the future. So it was probably a good idea. Do we have enough money to pay our bills? Well, we do have money in the bank. We still have $44,000 in the bank. We want to watch to make sure that we don't draw that down too far. So the year coming, we have to ask ourselves, what are we going to invest in? How can we get our revenues up? How can we decrease our expenses? These sorts of things in order to preserve that amount of money. But effectively, we have enough money to continue our business, and there's no signs of financial trouble. That is the purpose of a cash flow statement, to be able to make those decisions based on the cash flow, to say, where did our money go? Why did it go? What are we going to do into the future? What moves do we make? What moves should we not make? So that's a quick summary and overview of the cash flow section. If you have any questions, please let me know. Thanks for watching.